Hello, everyone. This is Zak Gardezy. I'm the host of Money Minutes. I'm also the founder and managing partner of Wealthstone, private wealth management, and a certified financial planner. So, here on Money Minutes, I'd like to share with you some of the latest market headlines and my outlook for what's ahead. So, on today's episode, I'm going to cover the latest market correction and what I believe to be the factors causing it, along with actions investors should avoid taking during times like these. So, let's get right into it. So, to kick things off, the market is currently experiencing what's known as a correction. So, a correction is a decline of 10% or more in the price of a security or index from its most recent peak. And corrections are normal and they can be triggered by various factors, such as economic data, geopolitical events, or just changes in investor sentiment. So, and we definitely have negative economic data and some serious geopolitical events that pose risks to the markets. And I'll get into that a little bit later. But investor sentiment, for example, it's at least among my clients, it hasn't changed much. Many of my clients are taking this opportunity to invest more. However, the rapid drop in stock prices paired with, domestic and geopolitical events shaping our world, have really caused a high level of stress and anxiety among the investors that I advise. I'd like to remind clients that corrections happen pretty often, and really as often as every 1 to 2 years, and tend to last a few weeks to sometimes months. But when a correction happens, emotions do start to kick in, and for many investors, the immediate instinct is to sell, to really avoid any further market losses. But just like when the market is rocketing upwards, our emotional instinct is to buy regardless of entry pricing so that we can get exposure and make gains. However, both emotion based decision making strategies require careful due diligence. For example, as we talked about on Money Minutes a couple of weeks ago, panic selling can be disastrous to a portfolio. We reviewed a data set from 2002 to 2023, which showed that, if a person missed a large number of successful days in the market, it could really significantly cause their portfolio to underperform compared to someone who stayed invested the entire time. Now, even that data is a bit subjective because, for example, if someone's invested in a basket of fairly worthless companies that are likely to never recover, such as some penny stocks or early stage, micro companies, it could be harmful to hold on to those compared to holding on to, like, let's say, Apple or Nvidia, for example. Now, from 1946 to February of 2020, there were 26 market corrections, and on average, the recoveries took about 4 months. So, the advice that I have for clients is to remain invested, and where possible, I'm looking for opportunities to put cash to work. For clients who have been sitting on the sidelines or had a recent liquidity event that brought in more cash to their portfolios. And in my view, looking at certain stocks with a long term lens, I'm seeing an excellent buying opportunity. Now, I'm not calling the bottom here, but I do feel that I'll look back at these entry prices, 1 to 2 years from now and be happy with them. And so, as the market continues to experience volatility heading towards the election and the end of the year, I'll be keeping a close eye on the latest developments and opportunities for clients. So, what's causing the latest correction? If you tune into any financial news channel, you'll find a million different reasons explaining, why the market is undergoing a correction. But, some can be right and many can be wrong. I don't watch very much financial news, mainly because I feel there's a lot of headlines that try more to catch attention and clicks, and really the hysteria from these headlines can be enough to send a retiree or any investor into panic. And I don't like that about mainstream news. So, in my view, there are three key reasons for what's causing this correction. Number one, weak economic data, especially in the labor market, which is a key indicator of a potential economic slowdown. We're seeing unemployment is going up, jobless claims are rising, and job openings are coming in lower than expected. And then secondly, geopolitical events, notably, the escalation of tensions in the Middle East. It has the entire world on edge, and any serious response from Iran could trigger a regional war and potentially higher oil prices. Historically, regional wars in the Middle East have had rippling effects, such as in 1973 with the Yom Kippur War, which led to stagflation, or the Gulf War oil shock, which caused a recession in the US and many other countries. So, and since the world is waiting for Iran's response, the worst case scenario creates a heightened risk and volatility in the markets. making sell-offs and panic selling a lot more likely. And lastly, domestic politics. In the US, President Joe Biden dropped out of the presidential race, and Vice President Kamala Harris has taken his spot as a Democratic Party's candidate. And Kamala's early success has caused a damper for any investors betting on the Trump trade, and the weak economic data, really that we've been getting, it's been expected. The Fed has clearly slowed down, the economy, and the economic data will continue to be stressful for the markets really until the Fed decides to cut interest rates, which is expected to happen sometime in September. But even then, the markets will want to see larger rate cuts, potentially multiple, before the confidence is restored. So, geopolitical events, they're always a wild card. The conflict in the Middle East could escalate to something regional. The war in Ukraine, for example, could spread across Europe or even go nuclear, and there could be escalation between China and Taiwan. So there are always risks, some known, some that are going to potentially catch us by surprise. But the most immediate risk is between Iran and Israel. As long as that conflict doesn't lead to something more widespread or severe, this period of escalation should pass like it did in April. But, if the two countries exchange significant attacks against each other, especially against civilians, this could easily turn into a regional conflict and a huge problem, such as, for oil prices and the global economy. So, and as I discussed with clients in my mid-year outlook, market volatility is expected to be high in the second half of the year. It's pretty common with elections. However, when all the votes are counted and a president is chosen, there may be some immediate market backlash, but generally investments, when there's volatility due to the election, it's not long term in terms of how it affects prices. So all in all, although the market appears, quite scary with potentially more downside ahead, I encourage you to look at this with a long-term horizon. And if you would like to have, the latest market events analyzed at a deeper, more unique level to your portfolio, please don't hesitate to reach out. And so this concludes this week's episode of Money Minutes. Thank you so much for tuning in, and I hope to see you all again next week.